hacking the decentralized finance for fun and endless profit. First things first, who I am. I have various experience in different domains. A developer at day, a reverse engineer at night, and also by experience I had to do work in data science, data mining and excavation, and at least 10 years in the financial sector, in the banking system. To 10 chapters, and in chapter 1 we're going to talk about the status quo. What is the existing financial system that people are trying to replace? Financial system, like having a payment method, like have a funding method. So all of these components of the financial system started to build on top of each other to provide the system that we see right now. The importance to break it down into pieces is to understand later on in that talk how these pieces will work when it comes to the future of the blockchain and the future. So, proponents of decentralized systems sees the existing financial system drawbacks. From their point of view, there's a couple of drawbacks. The most important and the obvious one is that the system is centralized. Only the government have hold on it. Central banks have the absolute monetary and financial policies on it, and also backed by laws and regulations that control every aspect of this financial system. After 9/11, there is a huge downward trend when it comes to privacy and financial systems in order to combat terrorism and also to combat anti-money laundering and fraud. So privacy becomes a major issue from the point of view for the proponents for the decentralized systems. Also, once the laws and regulations start to be more and more aggressive, permission by mean is that you're not always authorized to do a payment. You cannot do a transfer. You cannot open an account without having specific rules and regulations that decides if you are authorized to do so or not. So the system have a permission hierarchy, and instead of being you can do a transfer internationally and it takes 3 to 5 days, and there is no even guarantees that correspondent bank will respect it. Sometimes they have blockage, they have different rules, so speed is still impacted. There is no instant transfer around the world. Increases the distrust of this centralized system. If I cannot guarantee payments, if I cannot guarantee in 2016, people has lost the money value. So at that time, More than 95% of the Indian economy was cash, was based on cash, and accordingly, they lost the value of money. And the Central Bank of India need to print all of these amounts, and people rushed into banks just to replace the banknote, the piece of paper that hold their values. Definitely something like this, if in India itself, people start stopping accepting the country currency as a value holder and lost its legal tender. In 2007, for example, in Zimbabwe, we have a huge hyperinflation, which means that there is an inflation each and every day. In 2007, this inflation has come to exceed 25,000%. This is even when the government stopped reporting how much inflation it has. So almost within a span of a couple of months, every single money holder in Zimbabwe lost its entire value. So people stopped dealing with its currency and start replacing it with other currencies like US dollars for sure. And recently, almost everybody now knows 2021 Lebanese crisis, which is impacted by simply where one country at this stage was United States, due to a misregulation in a specific sector, was capable of doing a domino effect all over the world and all over the other economies. Now, after this brief description of what is the current status quo, the proponents for the decentralized systems now acting as a rebellion, they will propose a new solution coming to disrupt all of the financial system, which is Ethereum. So everything starts in 2007 with Bitcoin, and now it is considered as blockchain V1. And then in 2015, we have Ethereum, and is now considered as blockchain version 2. If we did a very high level comparison between the two blockchains, we're gonna see that the initial start is actually common. The proponents for decentralized finance, they wanted decentralization, trust, privacy, issuing their own currency without any inflation, having their own payment system, and all of these systems need to be permissionless, without any specific controls, and only controlled by demand and supply, the raw forces of the market economy. Now we can see that both Bitcoin and Ethereum basically achieved this. But with Ethereum, what makes it way better and way higher when it comes to comparison with Bitcoin is that it was able to provide what we called financial instruments. What we mean by financial instruments is that we need more than being able to do payments and transfers. We need to have funding, we need to have a mechanism of borrowing, lending, having shares, stocks, all kinds of derivatives, and able to trade with each other on these derivatives, stocks, and value holders that we have created. Now, in order for Ethereum to achieve this, we need to know a very important concept that has been iconed lately, and it is called the trilemma, and this will be chapter 3. The term try with the three I mentioned before. One of them, you're gonna discover that solving this problem become very trivial and easy, and we have a lot of technologies that can fulfill so. But if you put the three together, it's gonna be a big. Now we can see that even though Bitcoin, Ethereum, and many other blockchains has been already in existence for a long time, but they cannot scale enough to take hold of all the international economies and finance transactions. They cannot simply go with this. And we are compared with the current banking solutions, the card providers, for example. One of the famous card providers actually go as far as 15,000, while most of the blockchains is still in the lower 100 transactions per second. They cannot even achieve hundreds. Yes, there is a lot of different solution proposals, subchains, stuff like this. But again, when you try to propose such technical solutions, you're gonna see that you are impacting the security and the centralization. You can make a blockchain faster, but you're gonna lose the decentralization. You can make it more decentralized, but you're gonna lose the security, like losing the power of the proof of work or proof of stake. Now, the solution that Vela comes with the creation of Ethereum, is the concept of smart contracts. While the name seems fancy, but actually it's pretty simple. What if we created an application that simply enacts what two people wanted to interact together in a financial matter? So think of it like a basic contract, like I'm gonna borrow some money, you're gonna give it to me, I'm gonna repay it in X amount of months with an X amount of interest rate. Very basic financial controls by its logic and codes a financial transaction, and you need to secure the inputs and outputs for such program. Now, on a very high abstract level, if this idea was possible, and it is, it's gonna provide a lot of benefits. Basically, now, in order to make sure that nobody tries to manipulate this code, this program, in its execution, we need to make sure that this contract or this code can run absolutely autonomously without any human intervention. And we're gonna dig deep into this. Now, this hypothetical layer, this hypothetical idea that Velik provided in simply, hold on a minute, I'm getting something from the conference. Okay, I hope it's getting better now if they can communicate with us. Alright, so this hypothetical idea of a smart contract, as described in the white paper, provide 6 different things. First off, security. It's inherited by the blockchain and the cryptographic infrastructure. Speed and low cost, because you are executing computer code. So you do not need to have any human intervention, you do not need approvals, you do not need somebody to review something. Standardization comes when if we have a lot of contracts that are doing the same financial transaction, we can create a standard for such contract. We're going to have a reference implementation, a reference code that we can simply use, and everybody can make sure that this code is audited, secure enough, when we can simply reuse it everywhere. Now, accuracy. Definitely computers are more accurate blockchain can see this code, and whoever wrote this code execution process is actually as the developer intended. So we have this to have such high level and this beautiful idea of a smart contract, where it gonna execute. So it sounds good on paper. This is what caused us to the next chapter, the rise of the machine. And the machine, we talk about the Ethereum virtual machine. Now, this is a very, but it's very, very important to understand in our journey to decentralized finance. Now, we have a code that's gonna execute somehow. And we already said that we wanna validate and cryptographically ensure the security of such code, its inputs and outputs. Now, I cannot take this code and make it execute on a Windows machine, Linux machine, Mac machine. It doesn't work this way. We are on a blockchain. There's specific rules set to maximize the security and the consistency between all the nodes. So how are we going to achieve something like this? The creation of the virtual machine is that this machine, this piece of code, is capable of executing a specific code written for it, which is the code coming from the smart contract. But this machine have very specific characteristics. First, if we wanted to say the simple definition of solving any mathematical problem we throw at it. So this machine is almost as your CPU in your current computer. It can solve all the mathematical problems we throw at it. Now, transaction based means that it can do any computational calculation. Input, we have execution, and we have output. The three of them, this is a transaction. State one is that we apply the transaction on it. It's more like a get repository. So we have a commit. You have specific stage, specific commit. Then we have the difference between them. Then we have another commit. And as any other CPU that we usually know, there's some similarities. We have the operations as a microcode, and we have a memory, we have stack. The tricky part about it is that the memory in here, same as the computer, it's volatile, it's not saved. But everything written into its storage, it will be permanently saved as part of the blockchain itself. So now, the transaction itself has the inputs automatically saved on the blockchain. The code of the contract is already saved on the blockchain. And now we have even the outputs of the transaction is being saved on the permanent storage. So the permanent storage of the blockchain itself now have the three layers, the three stuff we talked about: input, output, and code. Permanently, securely saved on the blockchain. Now, to give it a more example and to have a real feeling of what it looks like, in this slide we have the code for a smart contract, and it is written in a specialized programming language called Solidity. the interface, what this contract is capable to do on its functions, and what outputs it's gonna generate out. The bytecodes will be saved on the blockchain. Now, Ethereum nodes, what we have talked about, is simply PCs that are running Ethereum node, a simple software that makes you a part of the global blockchain, decentralize the global blockchain. So once you run this piece of code, which is called an Ethereum node on your PC, you automatically enrolled into the blockchain. And in here we can see how many nodes worldwide exist, what is the ratio between the countries. Now, once these nodes start connecting to each other, what they're gonna do? First off, people who want to do transactions. And now we need to talk about what is a transaction. In the Bitcoin days, a transaction was simply sending a payment, sending a value of Bitcoin from one wallet to another. In Ethereum, we have exactly the same, but we have even more. Sometimes you are not sending a value. You are sending a transaction that is calling a smart contract. It asks for an execution of a contract that may or may not use funds, withdraw funds, deposit funds, or even more. So in this case, the cycle in how the transaction goes is very different from Bitcoin. Now, let's assume that we are starting the Ethereum blockchain from the very beginning, from block 0 on what's called as the Genesis block. Now, block 0 is simply empty. It has no transaction. This is proof of work, which means that you simply do a very mathematically complex operation using SHA-3 hashes and stuff like this to make it as complex as possible for all of the other network computers to crack such hash and invalidate the block. Now, when we go into block 1, now we have a lot of transactions has been issued and they are moving through. Then every node go to transaction. Next step, every 10 to 12 seconds, the Ethereum network issues the command for creating a block. So the nodes that are having the mining power, that is the computational power, they recommend specific amount of transactions from the memory pool that they see is the priority to come on top and to be cryptographically in this block. So the cycle starts with a large memory pool of transaction, which is, let's say, 1,000 transaction, and then the node that is responsible for the mining gonna select the top 100 transaction. The criteria for this selection is right now, what we call it the gas wars, is basically about how much the user is willing to pay as a fees for the execution of the transaction. So the highest fees of the transaction will be the top priority. So now the node will take the top 100 with the highest fees, and then they're gonna start executing one another. As we said, the classical way of Bitcoin, if this is simply a transfer from one wallet to another, this is very simple. It's gonna simply impact the balances of the two wallets. If this transaction is doing a contract call, the Ethereum way, now The blockchain need to fetch the code from whatever block it was submitted to, and then loads this contract code into the EVM, the Ethereum virtual machine, and start executing the code the state. Now, this permanent state is called the Ethereum balances and wallets and everything has execution EVM state. The block closes, mined, executed, and then we're gonna start a new block on the chain. And as we said, every 10 to 12 seconds we have a new block, so we have a new range of recommended transactions to be executed. Now, people start thinking about how advanced concepts on the Ethereum blockchain. We already understood that smart contract and how we're gonna do it. Now, what if we wanted something more? What if we wanted something big? So people come up with a very simple idea, is that if we glue together many smart contracts, we are actually creating a protocol. What we mean by this, we have said in the previous slide, is that a transaction is capable of calling a specific function on a contract with an input. But what we have didn't said yet is that this contract can call another contract after being initiated with the origin transaction. So one transaction comes, it gonna simply talk to the contract number one, and then contract number one can actually talk to contract number two within the scope of the execution, the context of the execution, with the first transaction. For insurance, whatever may be. Now we have a large group of contracts that they are communicating together and validating the logic for each one. The group of them is what's called a protocol, or a DeFi protocol, a decentralized finance protocol. Now, at the end of the day, we need to know that it's gonna look like weird, but we're gonna explain it now. On Ethereum, we have two types of wallets. We have externally owned wallets, which is a person, a human being, having some sort of Ethereum amount and balance, and he have a public key and a private key for encryption. Now, there is another type of account called internally owned, which is also known as vaults. Actually, every smart contract has a wallet, but since it's a smart contract and it has full autonomy on the blockchain, it doesn't need a public key and a private key, but it still can hold value and can even distribute value, and this we're going to explain later on. Now, Once we have all the pieces together, from the existing financial system to the invention of Ethereum and the smart contract with the EVM, and now with the basics of how Ethereum works, we can dive into the matrix of the DeFi. Now, the DeFi or decentralized finance is basically all about creating and also replicating the financial instruments that we have on the real physical financial system. So, as we said, in currencies, now we are replacing it with tokens. And these tokens have even a standard when it comes to smart contract perspective. Since we said smart contracts can be standardized, actually it happened. Now we have two a company comes in and say, all right, we're gonna tokens that we are. So any company, any person can simply create a smart contract that is compliant with EIP20 and issue shares and tokens to other people. Definitely, this is controlled by the market demand and supply, but this is the basic idea. Now, these tokens has no stable values. As we said, it's based on demand and supply. So this can actually push the market to create a more stable coins. Instead of token coins, we need stable coins. And stable coins are actually EIP20 tokens, but instead of being minted by whoever owns the contract and mint and generate as many tokens as he wants, he gonna actually connect it and force it to be one-to-one exchange with a fiat currency. So if you're gonna give me one physical dollar, US dollar, I'm gonna give you one stable USD coin. So now there is no exchange rate, it's fixed value, and this is where it comes from, stable coin. Now, non-fungible tokens, or NFTs as publicly known, are simply a representation of ownership. What we mean by this, one of the most famous problems is that for years people are creating art and other assets digitally. There is no physical manifestation for it, and that's why it's non-fungible. And still, when you buy it or put it on sale, there is no way to have an authenticity to get this art can actually transfer the more and more as shares or stocks to many startups and ideas on the blockchain. So there are thousands and thousands of all types of tokens. Inherently, people will start needing and demanding to exchange such tokens and stable coins and NFTs. And this necessitates the creation of the decentralized books and what's known as DEXs. So decentralized exchanges was actually a huge jump and makes a world difference when it comes to decentralized finance, because it was very necessary to have such thing in order to have a proliferation of the tokens, stable tokens and NFTs. Now, once you have an exchange and trading, and I say, all right, I need some loans. Why not to invest? We already know the concept of loans from the physical world, and we said that we can achieve this on the smart contract level on the decentralized finance. But what the blockchain provided is something called the flash loan. And flash loan actually has no comparison with any physical real world comparison, because this flash loan has no collaterals, has no securities on. The security for the flash loan is that when you are doing a transaction with it, you can only have the loan for one successful transaction within the period of a single Ethereum block. So you can take as much money as you want as a lending from somebody in a single transaction. The loan, if one of these conditions has been violated, the transaction will be, and they're gonna give you return on this investment. All of this done through protocols on the Ethereum network, through a network of smart contracts. Now, this is a sample for the stable coins. As we said, there is multiple types of the stable coins when it comes to fiat backed, which is backed by real banknotes. But then a new invention stable coin. One of them is called crypto back, which means that they are backed by a bunch of tokens or NFTs. The bunch of them, like an investment fund, it can be stable because one token can go up or down, but the other token will simply cancel its effect. So this is what means by crypto backed. Now, algorithmically backed, this means this is a purely an ERC20 token, but that to control the demand and supply, there is an algorithm built inside the token contract itself to control how much supply of tokens created or even destroyed in order to stabilize the demand and supply prices. This is a very advanced concept, but still it exists. So we have three types of stable coins. actually comes in, as we said, a group of smart contracts, but it comes with a very, very unique idea that has been replicated and caused a lot of interest to increase in the Ethereum blockchain, especially last year in the what has been called as the decentralized finance summer, next summer. What Uniswap has done is, in order to have an exchange on the blockchain, you actually need to have some sort of a back end. The price of the tokens that you are trying to swap together and specify how much the price and how much it reflects on the token within a pool pair. A pool pair is basically, you said, I want to exchange token A with token B. What should be the price for each one of them against each other? This is what the pair contract adds with a specific algorithm. It's too complicated to talk about it right now, but it simply is decision making process that is algorithmically correct and mathematically proven to always keep these tokens in balance with the demand and supply, and also give the owner of such tokens to increase the liquidity or decrease the liquidity as they are considered a liquidity providers for such tokens. Now, with the existence of such solution, ingenious solution, now people who owns a lot of tokens, and as I said, thousands and thousands of tokens and NFT, found their portal to start exchanging these tokens together and can actually buy and sell it if they don't care about it anymore, but they can increase their wealth by opening a trading in a completely decentralized form on the blockchain. Now, up until now, everything is very good, looks promising. Instrument they were able to replicate on the Ethereum blockchain, even exchanges and tokens and ownership and everything is almost contracts. You're gonna create complex idea like dexes. But the problem with the AVM comes with its intrinsics, its internals, how it actually works. Now, when we go a little bit deeper into what does a block mean, a block is simply a group of transactions, and it has a specific limitation of how many transactions it needs to be included in, how much fees should goes into a specific block. Now, once we have this layer done, we're gonna have another layer, which is the accounts that interact and issue transactions, which are both of them part of the world state. And what we mean by the world state is simply the balances of each wallet. What is the balance of the wallet? What is the storage output of a specific contract? And what is the storage input of a specific transaction? So if we connect all of this together, we're going to see that there is a very specific characteristics for the AVM itself, the Ethereum virtual machine. In this figure, we can see that once somebody issues a transaction, it's gonna go through multiple ways and gets the result. There's more details into it. Is that first off, when a transaction has been issued, We take the input of such transaction and the EVM need to decode this input once it has fetched its own code for the contract. And even we send it a transaction to trigger a function on it, and then this contract can communicate with many other contracts to do a more advanced thing. So, attack surface from security perspective. If you focus on security on a specific smart contract, no, because this contract will talk to another contract, will talk to another contract, and you have absolutely no control on it. So the attack surface is very, very big. You might do a security audit on your contract, but the other contract don't. With this intrinsics we talked about, automatically when trading comes on the Ethereum blockchain, it has abused such intrinsics. I'm gonna give 3 examples for such abusing, for the details of the implementation of the Ethereum blockchain. The first one will be blockchain versus time, which means that we said that every block takes 10 to 12 seconds to execute. So this 10 or 12 seconds is considered years of execution times for our fast computers. So if a transaction is pending in the memory pool, you can actually front run it or back run it before it gets executed. You have 12 seconds to play with it as everybody else in the wallet, because your transaction and the transaction you're interested in is cascaded all over the wallet through the node. You can also drain it, which means you can issue 2 transactions. For example, you can buy before the targeted transaction, leave the targeted transaction to buy, and then you can sell after it. What happens is that you bought twice, the price go up, and then you sell with the price go up, and the guy who bought will lose money. So he actually made a sandwich for such transaction. Vulnerable. Also, it can be very complicated, and we know that complexity is the enemy of security when we talk about huge decentralized protocols that spans many in absolute exclusivity for the entire world state of Ethereum. There is nothing as parallel execution. You cannot take 10 transactions and execute all of them in the same time. No, it doesn't work this way. Every single transaction, when it spin ups the EVM to start executing, it has the entire world stage to do whatever it wants in it. And that I name it as a singularity, is that single transaction across the entire Ethereum world state. Now, comparing the Ethereum blockchain and its security with the security techniques and playbook that we use right now, comparing to secure code editing and stuff like this, there's big differences that we need to understand. When you are doing a security audit or a secure code review on a specific application, we already have a mindset of presets, hardware, software, humans that are going to interact with these systems. So our all knowledge and playbook, instructions, standards, everything that we follow are all based on these presets. That we have a specific hardware, we have a piece of software running on a server, on a client, on a mobile device, and we have humans interact with it. So we need to do all of this stuff. But on the blockchain, it is completely different. There is no specific hardware. It's actually specific piece of software that you can audit by reverse engineering or secure code review. Now we have entire protocols. You have smart contracts, small pieces across thousands and thousands or even millions, and each one of them can touch any other contract they are interested in. So there is no easy scoping, and all of this is actually in dynamic state. It's always moving. But the classical way of doing security audits is that we are dealing with static stuff. This is your server, this is your software, and this is how everything goes. But now you cannot do this. Everything's moving. The moment you put something on the mainnet, the main network of the Ethereum, it is a snapshot to audit. Now, let's talk about a sample of hacks that already done on the blockchain. So in this chapter, we're gonna say it being Mr. Robot. So we said in the previous slide, talking about front running and back running and draining, this is a real example of how to actually execute it. You can see that 2 transactions has happened, ending with PP32. This is the public key for the issuer. He intentionally front run and back run the transaction that is ended by 615. He buy twice and sell, and the main reason for this because he gonna bump up the price, and once he started selling, he gonna give more than he invested initially. This is the draining concept. For sure it has a financial algorithm in the background, but I'm giving it as an example. This algorithm of draining is literally printing money. If you create the smart contracts and an application that can simply automate the algorithm, pool You can front running and back run it, and you can keep getting more money by defrauding the I've seen in the real life examples smart contracts that generate $10 by manipulating the price oracles for a specific token pair. Now, we talked about the token pair smart contract as the one responsible for balancing and deciding the price. Now, if you are able to take a flash loan, a huge amount of money, and you manipulate balance between these two tokens by changing the contract responsible for the pricing, you buy a lot of one token, so the other token simply goes high. This is a very simple manipulation. Now, if you manipulated the token for one block, you can actually do another transaction in the same block by making your own smart contract do a flash loan couple of times and doing a trades couple of times within the same block, because you have a lot of contracts working in together. This attack is feasible. As we can see in the screenshot, this attacker actually made 7 transactions and took 3 loans. They mixed it all together in his own finance algorithm and was capable of getting out with $45 to $50 million in one transaction. As about that, you have one transaction controlling the world state. You can do whatever you want within this time frame. Actually, a lot of companies start offering, as the ad we are seeing. This company, for example, is providing a way to develop trading on the Ethereum network. Now, the last chapter I want to talk about in here is that we need to rewrite the security playbook when we approach the concept of the blockchain, and especially the Ethereum blockchain or any EVM compatible chains. In this chapter, as a brief finale, we need to compare how the initiators and the process in the real life versus on the blockchain. You need to know who is your attacker. So in the real world, he has all the time in the world. He can plan his attack months and months and keep researching just to do or use a specific vulnerability in your software. But in the blockchain, he can't. He needs to make sure that whatever way he gonna do, it must be executed within the time frame and the restrictions of a single transaction. So he cannot have unlimited process and execution. Actually, every transaction have a specific set of operation codes that can be executed with a specific time frame. So in real world, we have unlimited amount of time. In here, we have a limited amount of time, how long the transaction execution is. On the real world, we have technical specification for the vulnerabilities. So most of the vulnerabilities we are tackling is technical. Technical people very highly skilled traders who know how to use the vulnerabilities in the algorithms for their own financial benefit. So no more the classical, this is a bug I'm gonna use to do a SQL injection and excavate some data or resell whatever. No, this is a highly sophisticated people such algorithmic problem, which we as a people who are coming from technical perspective cannot discover. I see the code works perfect, it's perfectly secure, but it's not easy to know that the algorithm that this code is using to calculate a specific price can be manipulated by 2-3 contracts in advance outside of your scope. Now, as I said, this domain is generic. The one on the network security, GRC, there's a lot of standards and everything. So you have many references to go back to. We already know this domain and there is a lot of people that can help you with it. But when you are talking about the security in the blockchain, it is completely different background. And it's very domain specific, especially when we talk about DEXs and decentralized finance. Now, in order to prove how difficult it is to apply the existing security playbooks on the blockchain, actually we have a website called Reddit that do some sort of a shame list for all the security companies who did a security audit on a financial or in a DeFi or a token or anything that is deployed on the blockchain, one of the things we talked about. And in front of you is simply a big shame list for all the security companies that failed to do the basic auditing and yet they got hacked. So yes, if you go as a company and try to do a secure code review, it's okay, you're gonna issue a report, all the problems as is fixed, but again, you still can be hacked. Or completely decentralize the application that doesn't care about the finance that we talked about in the blockchain, but actually cares about other things that they can do with the blockchain. So we need a huge investment in research and development. We need to create a next gen tooling. There is no tools. This is a brand new stuff. Yes, there is some tools available, but we need to have a next generation of tooling. We need to create the burb of the blockchain. We need to create the SIM solutions for the blockchain. I'm giving you an example that now, lastly, a new playbook. We cannot use the existing security playbook that we have developed for years and years for our standard security practice for existing software and hardware. We need to write a new one that is customized for this specific domain, the blockchain. So we need to write a new playbook for this. The good news is, at least we have started. I have created many tools and bunch of my friends in order to at least have a basic infrastructure in how to navigate this new uncharted territory. Reverse engineering a contract, debugging a contract, stuff like this. This is a basic and a given for existing security engineers. But on the blockchain, it's not a given. It does not exist. To have a debugger that can go step by step for every instruction inside the Ethereum virtual machine, it does not exist. And in order to achieve such thing, in our existing computers, you simply give an operation code for your processor and say, okay, run in debug mode. There is no debug mode on the Ethereum virtual machine. We actually had to recreate the entire Ethereum virtual machine, wrote it from scratch to make it able to support debugging and execution as step by step, and extract the operation code and see the memory profiles, the storage profile, the keys and everything. So it's not even that easy to do with the existing software and hardware infrastructure. So we already started, and we hope that by this talk people will gain interest in such domain and start investing more time and resources in order to make our landmark on the blockchain and the decentralized finance security perspective. About really knowing the blockchain. We need a lot more people who deeply understand the blockchain before navigating